So when I told you my story about the Fed, it just dawned on me that I made a mistake in how I told the story. Okay, I need to issue a correction in the way that I framed it in my former video about this particular topic and why I'm so concerned about the deflation picture myself. Okay, first of all, the Fed had a guidance window, right, that it was aiming for of about 2% inflation. And the more that I understood macroeconomics, the more that I was aware that most economists are of the position that some inflation is good, but too much inflation is bad, right? And following the financial crisis way back in like 2007, um, what happened was a deflationary situation. Okay, basically, if the federal government had not acted to bail out the banks, we would be looking at a deflationary crisis, the style of the Great Depression. You know, so the last time we went through something like that, we were in a deflationary situation, and a deflationary crisis was literally the financial crisis, but before the government went to the bailout in response to it. Before there was any government action, but right after the Lehman Brothers collapse. In that narrow window, that was the last time we'd experienced deflation in this country. And so the Federal Reserve had engaged in unprecedented actions to create 2% inflation as its target window. And yet, for from about 2007 to about 2000 to about 2019, and like the third and fourth quarter, you know, of that year, you had seen inflation numbers come out year to year at about 0.6% at most. So, what that means, if you think about it, hold those thoughts in your heads for just a bit, to understand my frame of reference and what has me concerned. Hold it, process it, let it sit in, let it sink. Okay, you got it? Now, think about the fact that it was only going up 0.6% year to year, and the velocity of money, which I will link in this doc. Every time I looked into it, it was collapsing. Basically, the velocity of money, from what I can see, peaked somewhere back in like the third quarter of like 1997, probably like right during the tech bubble, and it's been in a line that does basically this ever since. It does a very really it's like this, but the trend, if you were to actually draw a line through the graph the way an analyst would show it, I would show that it's just been down, 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 to where it was, in 1997, it was about 2.192. And then now all the way in the current quarter, like what is it at in quarter one of 2022? That's at 1.122, in the first quarter of 2022. So that is a collapse in the velocity of M2 money stock, that's been ongoing for that entire time since about 1997. The Fed has thrown the kitchen sink at trying to boost aggregate demand through its actions to the point in which it would be able to stimulate the economy enough that it would create 2% inflation. And now you're thinking to yourselves, right here, right now, right, that, and this is the thing that's so like mind fucking, is that you've been thinking to yourselves, I've gone grocery shopping, I've seen the prices out there, this is the the inflation that they've been warning us about this entire time. I'm right, my opinion's completely valid, there's no way this guy is right, he's completely crazy, he's just screaming about deflation, and he must be completely irrational. But the problem with all of that is that the M2 money, money thing has completely collapsed. And I may be screaming into the wilderness to anybody that might listen, but the truth of the matter is that they were failing to meet their target window, despite completely unprecedented action and a drastic intervention into the economy, where they had pretty much thrown the sink at it. And it persisted in a state in which inflation was muted at best for over 15 years until COVID-19 broke out. And so what we are looking at is a supply chain breakdown instead of a weakened dollar, you know? And what is so astonishing about all of this is just that the dollar itself, right? If you're reading the headlines that I'm showing you, the DXY is at 101 right now, but it just recently tested 105, you know, very recently, which was a 20-year high. You'd have to rewind the clock all the way back to 2022 to see the strength, which means that what you're looking at is not a world in which the dollar has actually weakened. You're looking at a world in which, due to the credit, not to the credit, but to the supply chain crisis that we're in currently, you know, uh, the dollar strengthened, and yet we were robbed of the benefits of it by the fact that all those goods went up faster than the dollar went up. So both are in an upward trend and have been, but one, like I said, is going up faster than the other. But, you know, all of that. Now keep all of that right there. The Fed is not meeting its guidance targets. And then think about the debt and US households and how much money they owe in some of the other articles I've linked. 16 trillion in US household debt. You know, a credit financed, irrational exuberance in the markets, as they would say. So you have all this, consumer data that's showing that there's robust demands for goods and services, but it was bought for the most part on people's credit cards. So what is going to happen to aggregate demand when everybody is indebted? The Fed has been trying to engage in and has been scared shitless of deflation. It's been fighting it with tooth and nail the whole time, and yet its ability to stimulate inflation has been anemic, and that the current round of inflation has nothing to do with the Fed's policy window, and everything to do with the fact that COVID caused shutdowns in China and rolling shutdowns to the supply chain. I mean, think about this. Think about all of these factors. Like they're spiraling through your head, and you're realizing, that if you consider all this and you factor it all in, you can't explain the current state of goods on the shelves with a weakened dollar anymore. Once that explanation is ruled out, it's not the helicopter money. It can't be the helicopter money because the dollar is actually stronger than it was before the Fed's interventions. So what does that mean? Ultimately, what is the implication of all of that? It's that the Fed was losing the battle on deflation before, COVID struck. It's and the current round of inflation can only be we can thank a virus for it. Like we can't blame a weakened dollar for it. We can blame Corona for it. So that means like the implication of all of those factors is that the deflationary reaper, is coming, and the people that have been shouting about it and warning you about it are not wrong. I know that people have been arguing that deflation is good, but there's a reason why economists have feared it for this entire time. If you know what a deflationary spiral is, and I will link it in the video, deflation is good for the individual consumer, but it's terrible for the macro economy. So deflationary spiral, Khan Academy would be my fallback on this, to link in the underbar, but what a deflationary spiral actually does, and the reinforcing feedback loops that it actually causes. So people like me have been worried about this too. I share the Fed's concern, about what's coming. And I don't know how we can avoid it in a world in which everybody is now loaded up on debt and credit card debt and all of this that, that may be the very thing that triggers the deflationary crisis.